International in Los Angeles, and I have the great pleasure of introducing Obie Walli, who's going to speak on the subject of, I may get it wrong, but valuation, the transition of stock within our companies, and many other topics. And I recommend Obie from experience. About 6 years ago, Frank Schultz, who's muted, and I were trying to negotiate a sale of my stock to Frank and 3 other shareholders for the purposes of diluting me and giving ownership interest to them. And we were stuck. And we brought Obie in, and he facilitated a great process of not only valuing the company and helping us do the stock sale, but we restructured our compensation for the purpose of retention of not only the shareholders, but inducing salespeople to stick around and participate in a bonus pool if they earn above a certain level. And I'm and in his other life, which is probably his bigger life, Obie's been a very good and loyal sponsor to CORFAC International for his software product that many of you know about, or all of us know about, Dealius. And Obie, I'm happy to participate if you want to ask me any questions or get color, and take it away.
Absolutely. Well, thank you, David, for the introduction, and good morning, good afternoon, everybody. Excited to be leading this session today, and more importantly, sort of give you hopefully some insight, share some information, and allow everybody to walk away a little bit more informed on the topic that we're going to discuss, which is really focused on succession planning and thinking about the next stage of your business. And for all of you on the call, you might be at various stages in the life cycle of your specific businesses, whether you're looking at potentially bringing on new shareholders into the company, or looking at planning for, at some point, a transition of your business to the next generation. And so what we're going to talk about today is just some key elements of areas of focus that hopefully we'll shed some light on today, talk through some structure, talk through some key points of consideration. And then towards the end of the call, I'll open it up for Q&A. So during the session, if you do have any questions, I would just ask that you put them into the chat group, and then I'll try to my best to address them towards the end. So I will now share my screen, and just want to make sure everybody can see it.
We got it.
Okay, perfect. So I'm going to kick off with the agenda for today. And really what we're going to talk about is regarding succession planning, sort of transitioning your business, or what are some of the industry trends we're seeing today as a business. And next, we're going to talk about, are you ready to transition your business? And keeping in mind that planning is key as part of this. And there are certain things for you all to be thinking about depending on the stages of each of your businesses and where you're personally at in the stage of your professional and sort of ownership cycle of the business itself. We'll address some best practices and areas that we've been involved in as far as recommendations as you're thinking about bringing on the next level of ownership, and some of the key things to consider. I'll hit on some case studies that we've worked on, and then I'll open it up to Q&A. So the first thing I want to hit on is sort of industry trends. What are we seeing in the market? We're in a service-based industry, right? A lot of our businesses here, core business is brokerage services. Some of us may have property management as well. But interestingly enough, over the last 2 to 3 years, what we've seen is a demographic shift in the industry, right? You're seeing a cycle of ownership that's starting to age out. Not to say that everybody's retiring, but everybody's looking at the current cycle and previous cycles and saying, do I want to do this for 10 more years? Or am I ready now to start to hand the baton off to the next generation, be it family, be it, within the company, top employees, top producing brokers, and what do I need to be doing to start thinking about that? So from our perspective, we've started to see a shift occur in the marketplace where owners are now starting to really think about what is that next stage that I want to consider, winding down, not necessarily having all the day-to-day responsibilities of being a principal, but starting to bring in others that can help in managing the business and growing and continuing to develop the business as well. One of the interesting facts, and this is a general fact, that 1/3 of all privately held businesses in our industry have no succession plan. And that should say only 1/3 have a succession plan, 2/3 have no succession plan. So that means that 33% of all companies, and these are privately held businesses, have thought about it, have done something, while the other 2/3 have done nothing. And I'll go into sort of what that means. And what we're seeing is a transition into the next cycle of our industry. What we're seeing is technology having a greater impact in how we do business, and how can we sort of continue to leverage that and adopt that, not just solely based on the needs of our clients, but also how is our current leadership team and our current sort of brokers taking advantage of this. And so what this is also doing is creating a cycle where that next gen leadership and entrepreneurs are adopting and embracing technology more than we've seen in the past. At the end of the day, it is still a relationship driven business, but how we do business now is becoming more sort of streamlined and technologized, if that's a word, into how we do things on a regular and daily basis. And I think coming out of this last situation and scenario with COVID and the pandemic, it's really forced and accelerated our industry to look at technology through a different lens. And what it's done is also accelerated the thought process of ownership to say, what am I doing to bring in that next generation of leadership and that mindset that they have to allow our businesses to continue to thrive. And for some of us on this call, and maybe most of the business owners on this call, your businesses have been around for decades, right? So you've been through cycles, you've been through the ups and downs, and we're starting to see a change in our industry, and you're adopting to that and adapting to it. And what are some of the things to consider as we go through that? So next thing is just key points of consideration as we're talking about this process is the best thing to be doing is planning and thinking and looking forward. Most companies that I've spoken to in the past 5, 7, 10 years, we've always said that you have to plan 3 to 5 years out if you're looking to transition and start to bring in that next generation of leadership. Establish your own personal goals. What is it that you want to do? How much ownership do you want to retain? What role do you want to play in the company? Do you want to just step away from the day-to-day management and just produce? Do you want to have a smaller role in management? Do you just want to get out totally? So all of those sort of personal goals as owners, and there may be more than one owner, each one may have their own personal goals, but to understand those, address those, and work through those so that you can transition the business that you have today to the next generation. Now, also keeping in mind that since our business is a relationship-driven business, a lot of principals are player coaches, right? So you're not just managing the business, you're generating income for the business. And those relationships are valuable and key to you as principals. So things to think about is how are you transitioning those relationships as well? And what are the things that you're doing to think about that? And then the next level is leadership, both on the sales side and the management side. So as we all know from all of our own experiences, the best managers are not the top producers in the business, because a lot of times you want them to do what they do best, which is generate income and produce and continue to take advantage and leverage their relationships. So those two are not necessarily symbiotic. They could be, but in a lot of cases, you want to have someone that can manage the business, as well as think about those individuals that are in sales roles that generate a large portion of your revenue, or enough of an influence in the business that you want to retain them and keep them in for a long time. So this also becomes a retention exercise as well, and an opportunity for those individuals to create wealth and value for an asset that they currently may not have any ownership in as a whole. So let's talk about some of the key points of a business transition and what we sort of go through as our exercise with a lot of principals that we talk to. Why now? I was asked that question, why now? And a lot of times that question comes down to the personal goals of the owners. What is your desire to work through another economic cycle? We're currently in an interesting time where the government has played a large role in sort of keeping our economy at bay. Interest rates are an all-time low. That's not sustainable. Through the pandemic, we've seen a significant increase in demand for industrial product, which has created a boom in that sector of the industry. Office and retail took a hit during this time, and they're going to have to sort of readjust and modify to figure out ways to continue to keep those assets at bay and continue to drive demand for those assets. So all those things are playing into this discussion, but more importantly is, what does that next cycle look like? And are we ready to continue through that next cycle, or we want to prepare for a transition? What is the day-to-day management and role that you want to play as a principal going forward? And what is the legacy and the continuity of the business? So a lot of businesses have options, right? You can transition internally. You can transition through a potential sale of the business, a merger of the business. All of those have implications and are things we're going to talk about today. So how do you go about this process? What are some of the things to think about? And from that perspective, it's really about leadership and expectations of roles. A lot of businesses have individuals that have been with them for many years, sometimes decades, and sometimes in the last 5 or 10 years, but they all have a value they bring to the business. You want to keep those assets because our greatest assets are our people. Keep them motivated, keep them feeling like they're part of something, that they have ownership. And so making sure that you define and select those individuals and give them the path and the opportunity to become a principal or continue to build wealth through ownership are things that you need to be thinking about, which goes into the concept of an internal sale of your enterprise, because that's different than selling your business to a third party. Two different exercises, and I'll establish that as well as we talk through this. But what does this look like as you're going through a succession or a transition of your business? And I think it's important to note that there are many variables that come into play here. One thing is, what's the structure of a potential transfer or sale within the business? Each of you have a business and have operating agreements or shareholder agreements. Each of them are your governing documents. What do you need to do to amend those documents to prepare for a situation like this, or to plan for a situation like this, which rolls into buy-sell agreements? I consider the buy-sell agreement as sort of the prenup of a business, because that clearly defines how and what has to occur in the event of a sale of shares within the business, in the event of a death, a disability, in the event of adding a new shareholder. So all of those things are critical as you're thinking through this process. And then the last two pieces are, anytime you bring in a shareholder, anytime you bring in a new principal to the business, I'm a big believer that you got to show them value. What is that value that you're showing them? Present them with, what is the ROI of being an owner? What are the benefits of being an owner? How is value being created outside of just their own personal production potentially, or just in the management functions that they play day to day? Because with ownership comes some risks as well, right? It's not a risk-free opportunity. So we've got to be able to show what that means to anybody coming into the business as well. And then the last piece is, and I've addressed this a few times, but what is the role of any individual that's looking to sort of transition or sell their shares and take on less ownership as potentially a founding partner or a majority shareholder in the business as well? So we're going to hit on each of these points and sort of dive into each one at a not at a sort of a in the weeds level, but enough to hopefully provide you with some informative discussion here as we continue down this session. So one of the most important things about succession planning is to have the plan, right? And to properly plan for it. And as I said before, most people don't think about this till it's too late. It's one of the most important decisions as a business. But again, 2/3 of businesses out there don't even approach it until they're at a point in life where they don't have a choice but to do it, or it's forced, which is not the position you want to be in as an owner. It also requires a balance between your personal and business assets. You're planning for your own personal goals, whether it's for your family, for your, your children, your next generation, if they're not in the business. But you also want to look at your business assets and say, you've worked hard for all these decades to build an asset that has value. How do you monetize that asset? And what are some of the things you need to be thinking about? Because in some cases, and in a lot of cases, your business could be your largest single asset that you have outside of other investments. But keep that in mind, that your business is an asset that you've built. And, how do you sort of continue to benefit from it long term outside of your transition as well? And so two key questions I ask owners as they're looking to either retire or transition their business out is, what do you want to do? Do you still want to work in the company? As you exit, do you still want to just be in the, in a production role? And what does that look like for you? What does that mean? How much have you, historically generated for the business? And is that going to impact the value of the business going forward? So we have to think about those elements as well. And if you're not planning to continue with the business, if this is a full exit where you're retiring, what and how are you going to be able to manage and maintain those benefits that you currently have today through the company? And what does that goal look like, both economically as well as, personally for your family too? And the other thing to think about is the one thing about why businesses sort of start to come apart, or you'll hear about businesses that, sort of at some point transition out, or just sort of wind down. And the reason for that is just honestly, it's lack of planning. The owner gets sick, gets disabled, something happens, God forbid they pass away. They just let so much time pass that they didn't take advantage of an opportunity to retain their people. And that's when you start to see people leave because they felt like they weren't appreciated, or the value they brought wasn't realized, or the principal themselves just really never got around to it. So, it's like anything else in life. Anything that's important and valuable to you, you have to plan and prepare and make sure that you keep that asset as valuable as you can, and transition that asset to the level that allows you to benefit from it long term and maintain your legacy as well. So what are some of the things to think about in accomplishing this? Transfer of control according to the way you want to transfer it. Now, what do I mean by that? So today you may own 70% of your business, 50% of your business, 30% of your business. You may have other partners. You don't have to do an all or nothing scenario. A transition and a transfer doesn't have to be all or nothing. It could be staggered. It could be over time. You may want to sell 30% of your interest now, and then another 30% in 5 years, and then another 30% in 5 more years, and maintain 10% as passive income. So there's many ways to sort of structure these type of scenarios. And the most important thing is understanding the needs and the goal of each of the owners, because they may all be different. Not everybody has the same goals and objectives, even though you're partners in the business itself. Make sure that when we work on a succession plan, or you work on one, that it's done in an orderly fashion. What I mean by that is, make sure that people that you want to take over the business, if it is an internal opportunity, are aware of that opportunity, and they understand that you're grooming them, and that they're going to eventually have this opportunity to buy into the business. Waiting till the last minute or bringing it up when they're ready to leave isn't the best strategy, right? Because at that point, you're essentially reacting and responding, and not necessarily giving justice to what you've built. So it does take time. It doesn't happen overnight. That 3 to 5 year cycle is very important. Thinking through that process is critical. And if it's important for you to have a legacy and create one, this is part of that process, right? If your name is on that the sign on the building, that's legacy, right? If you want to retain that legacy, then there's part of this process comes with it. There are businesses that have been around for generations. Why? They've actually, taken the effort, the time, and all the nuances of trying to get it done. Or it might have been in a way where others have come in and said, hey, you need to figure out how to transition this business. So all of those play a role, and realize that if you've built a successful business over time, it has value. What that value is has to be recognized and realized, and you have an opportunity to benefit from that value. And it's just a matter of taking the steps and executing on a plan to do so. And then reducing risk as well. What do I mean by that? And I'll go into this, is that, in a lot of cases, the individuals buying your shares or potentially the potential purchasers of shares aren't liquid enough to write you a check for $1 million or $500,000 or $250,000, whatever that is. So you've got to take into consideration of what is that process? How do you bankroll that? Is it seller financing? Is it that they have to get leverage? Is it they have to put a down payment? So all those things are going to come into play as we go through this process as well, of sort of putting all these elements into play. So we talked about how we do this. Who are the next leaders of your business? How do you define or determine that, right? Most of you know that based on the tenure of the individuals in your business, the contribution they've made to your company. If they're a top, if they're a broker in your business, they've been steady, they've shown leadership skills, they've done a great job of sort of promoting the company, being an ambassador of the company, have brought, sort of good accretive value to the business. Those are the individuals that you want to keep and retain. Do they have a management ability? They may or may not. That's something you're going to know over time. And one of the things that I get asked a lot is, hey, I've got a very influential person, top producer that's coming from outside. They're with a nationally recognized brand. I want to bring them in. I want to give them equity. I always ask the question, well, how do they fit culturally with your business? How are they going to be received and perceived by those individuals in your company today that have continued to create value for your business? And is it necessarily the right thing to do on day one? How about having them earn their way in? How about proving themselves first? And how about promoting from within the leadership you have today, so that you don't have sort of this fallout potentially from your own talent pool that you have sitting there within your business? And in a lot of cases, owners have family, sons and daughters that are in the business. What role do they play? Are they active in the business? Are they creating value in the business? And are they, quite frankly, ready or mature enough or at a point where they can step up and take over and potentially take on more of a role in the business? And those are all the things that sort of play a role in this defining who the next leaders are. How are they adapting to the market? What are they doing to help continue to grow and build and recruit and retain talent as well? All those things play a key role. And then once you've determined who those individuals are, start to have those conversations, and help them understand that ownership brings value, and we have a model that we've built where we've sat down with sort of principals and their potential future stakeholders to say, here's the model, here's the value this creates. If the business performs at this level, this is what it means to you as a shareholder. What is that value? What is the value of that asset in 5 years, in 3 years? If the business just stays flat, what about distributions and dividends, compensation and other benefits that they receive? What's their ROI? This is an investment. They're buying into the business. If they have to put up 500,000 or 700,000 or 200,000 over a period of time, you want to show them a return on that investment, because otherwise they're going to kind of scratch their heads and saying, I'm making X today. If I put Y into this, I'm not seeing the return. Why do I want to do this? And so, a lot of times people want to be principals and owners without the risk, but the reality is that they have to understand that, in addition to being a principal and owner, it comes with economic benefits as well as, certain responsibilities too. And those are things that they have to look at, consider, and take and factor into their decision as well. But more importantly, for owners like yourselves, to understand who those individuals are and start to sort of train them and mold them and mentor them into a role that hopefully they'll be eager to take on once they're ready. So now that we've addressed sort of the who, the benefits of the ownership, let's talk about some of the best practices and things to consider as you're going through a potential transition. Okay. I mentioned the buy-sell agreement. This is probably the most critical document in the process, only because it'll define in your current operating agreement or shareholder agreement how transitions occur, how transfers of ownership occur, how are they structured, And that could be part of this process where you're creating a buy sell and amending your operating agreement or shareholder agreement to incorporate this because you're bringing new owners in. You know, a lot of companies have legacy ownership where they formed the business 10, 15, 20 years ago and haven't really brought anybody else into the business. And they're now going through this exercise for the first time. So things that we look at, things that we talk about is, do you have a buy sell agreement? And if not, let's talk about what it's going to take to create one. And are all the parties, if you do have one, has that been executed? Is it reviewed annually? Because a buy sell has certain provisions in it that talk about how shares are transferred, how new shareholders are brought in, how current shareholders are exiting. That may be functions of a death, a disability, a sale. There's many things that go into the sort of those elements of the agreement or provisions. One of the key things that I always look at is, how is a potential sale defined in your agreement? How is your business valued? What is the formula? So that way it's clearly defined, because the last thing you want to do is get into a dispute, right? A lot of companies don't have that defined. And what ends up happening is now you're going back and forth to say, well, I think the shares are worth this, and no, I think they're worth that. And now you're not necessarily in the same place, but having this sort of document defines and governs that. The other thing I also talk about with companies is you may have multiple shareholders, and if you have a business that's of material value, you want to think about how are you funding buy sell agreements with life insurance, because a life insurance policy can easily become a monetary asset that in the event, God forbid, in the event of an owner passing, that becomes a natural asset to purchase their shares and then have their trust or estate get the benefit of that sale. So things to consider there. And then the other elements are just valuation and payment terms. And we'll go into some of those things as well. But, this is the first thing you need to have, is sort of understanding what the buy sell agreement is for internally of the business and for new shareholders coming in. Now let's talk about, what are some of the transition scenarios, right? One is if you're selling stock to a family member. This is one scenario where you may have a son, a daughter, a nephew, whoever that is in the business, and you're looking to transition that business to them. So some of the things to consider: A, you got to define fair market value, right? What is the fair market value of the business? The IRS also allows you, if you have a family member, to essentially give them annual gifts, which could be shares of the business that have certain tax benefits. I'm not a tax expert, so I'm not going to go into the details of that, but I will tell you that those options exist. You got to ask yourself, if you're transitioning a business for the sake of family, are they the best qualified person to transfer the business to? They may or may not be. It's something to think about. What effect does it have on your people, both the employees and your brokers as well? How are they going to receive or perceive this person? Will they pay fair market value? A lot of times when you have internal sales, it's modeled at a discount. There's a minority discount involved. But it's based off of a fair market value. It's not just some random number thrown up that we come up with in the air. So, there's all these sort of discussions and dialogues that have to be made. And if you have reasonable sort of discussions, then you can get to a arrangement. Thinking about how the monetization of the business occurs, how they pay. What happens if you have non-family management team members and a family members coming in? What does that do to this sort of culture and the environment? And then, we'll go into I'm not going to touch base on the estate planning issues or other children, but these are just some of the things to keep in mind. And then I'm going to go into the next page, which is probably the most common one that I'm seeing right now, is the sale to key employees or brokers within the business. And this is by far probably the most common discussion that we have, is you have individuals that are there in the business that are key employees of the business, or 8 brokers that have been with the business for a long time that have added a tremendous amount of value. How do you get them to sort of go through this process? And you've got to ask yourself sort of the questions of, how are they going to fund this? How are you going to help them fund it, right? And can they get financing if you need, or can you sell or finance it, which is probably the most common approach. What risks do they have? And this is where you got to show them and walk them through the roadmap of, here's the risk of being an owner, but here's all the benefits of being an owner, right? Here's the cash flow of the business that we will support, that will be able to allow you to benefit and retain these benefits. Think of it as passive income, as an annuity, right? If your business, if you're producing $500,000 a year in gross commission income and you're making $300,000, $400,000, and the business can make you another $100,000 in distributions or 150, think of that as your, you know, your annuity or passive income that's being created through not just your efforts, but the efforts of the ownership as a whole. So sort of showing them that pathway. Another way to think about sort of allowing them to buy in is deferred comp. You know, they don't have to necessarily take their compensation in a given year. They can defer it and then use that as a means of funding the purchase as well. The last part of an exit, which is what I talked to principals about, is if you don't have family, if you don't have anybody else in the company that you can sell it to, and there's nobody really sort of looking at your business and you don't have that opportunity, then maybe it's an opportunity to sell or merge, right? So things that we've seen a lot in the last few months have been mergers. They've been very common privately, you know, between two businesses in a local market. Why are we seeing mergers? It's because it's allowing for companies that sort of have been friendly competitors to some level to scale their businesses, eliminate the redundancies, create higher margins, and allow those businesses to succeed long term. And quite frankly, a lot of them didn't really have some of the elements of a solid either leadership and management plan going forward. So I always say, like, you know, in every sort of business we've spoken to, it's been, if you don't have a succession plan, you don't have anybody else that you can think of that can step up and take over the business, what are your options, right? At that point, you got to think about, what's my exit? Otherwise, the asset of the business is only as good as your ability to run and own that business. Is there an opportunity to merge in the market and be able to potentially create value through that, where you can monetize some of your shares and transition out as well? So when you think about sort of succession planning, there's always, I look at everything in three core functions. One is selling to family or other potential family internally, your internal leadership and brokerage. And if you can't address those two, then what are your options after that? Or if you don't have those two, then you need to start thinking about, how do I create those two as well? So all things to consider, all things to talk about and sort of dive into. And again, my goal today is really to give you something to think about, information that will help you sort of go back and start to think through certain pieces of this, again, depending on where each of you are in your business cycle. And then hopefully it'll start to allow for some dialogue as well as you start to think through the process. So we'll take sort of the scenario where, you know, you're at a point where you've determined you're ready to sort of go through the process. You've defined and determined who the people are that are gonna be your next ownership team. You've gone through the discussions with them. They're all sort of, you know, ready to move forward. Now you start to get into what I call the nitty gritty. The rubber hits the road. And what are those elements, right? Now you're talking about selling your shares to somebody within the business that has been with the business for some time. So key things to consider, first and foremost, is you've got to understand the value of your business, okay? When it comes to valuation, there's certain things to keep in mind. There are two potential values. One is when you value your business marketable to a third party. That's when someone else is looking at buying your company. The second is non-marketable sale, where you're selling it internally to your shareholders. When you do that, you have to factor in discounts that are tied to a non-marketable sale versus a marketable sale, two different things. You also have to keep in mind that when you're selling your business, if you're continuing to realize benefits as an owner, all those things are still in the operating expenses. So we got to first determine the value of the enterprise, number one. Number two then is you got to talk about what's the structure of the sale. Are you expecting a down payment? Where's that down payment coming from? Are you going to be able to finance this deal through a note? And that note could be funded as a sort of a promissory note internally, where the shares or the units are essentially the security that's backing it. And what is the term? Traditionally, we see 5 years is the most common. Some cases it's 3. Common is most 5. We've seen them as long as 7 and 10 with an interest rate pegged to them. And typically what we've seen is the repayment of the payment of that promissory note typically will come out of preferred distribution. So they won't see any distributions because they're getting essentially paying it back through those distributions, right? Or it might come out of commissions as well, or their savings, whatever it is. But you've got to think through where that capital initially is coming from and how that's going to be structured. And then options. What are some options of a sale? You may not want to sell all of your interest on day one, because the minute you exercise a sale agreement, your units are now being transferred to that other individual. So if you own 50% and you don't want to sell 50%, you might sell 10% now, 15% in 5 years, and then maybe another 5% to retain some long-term. So those are things to consider as an owner. Number two is warrants. You might issue warrants in the business where you're giving individuals the ability or an option to buy in at an agreed upon price today, so that they can lock into a purchase price without having to sort of renegotiate in the future. So all things to consider and think about as you're going through this exercise with your team as well. So I'm going to now dive into case studies, and I'm going to show you two models that we've worked on. I don't know if you guys can all see this. This is a lot of numbers on the screen here, but essentially one model that I'm going to show you is the first one, which is a scenario where we worked with a company down in the Southeast, and they were looking at bringing on one of their tenured seasoned brokers into the partnership. And we built this model to show him sort of what's your buy-in, what are the economics. If you're on a 65% split today as a partner, all the partners are on a 50-50 split, right? What does that mean? But all partners also get salary plus benefits. So we walked them through to say, let's see what this means. So in this scenario, what we did was we showed that senior sort of broker who's coming in as an owner to say, here's sort of the average historical earnings of the business, 3-year average. This is the market value of $6 million on 1.2 million of EBITDA. We took a 20%, we put a discounted value on that to say, as an incumbent member of the team, we're going to discount that value. So taking it from 6.1 to 4.9. And then we said they want to buy 20% of the interest. What is that worth? We factored it into a down payment plus a 5-year note at a 9% rate. And we showed them what their principal payments were and everything. And we said, let's look at sort of what this looks like to you initially and over time, so that even if you're on a 50% split, when you factor in your benefits, you factor in sort of the splits, your note distributions, even after all that, you're still netting $30,000 more a year. Nothing changes, right? And then down here, we were able to show them sort of the next 8 years, 9 years. What does it mean? Distributions, if it stays flat, your repayment of the note, your total value at the end of the life cycle of the market, and then your IRR, which is your annual sort of income that you're going to get. In the first year, you have to put cash out, so you'll be negative, but starting in year 2 to year 8, you can see what that does every year. And then what we were able to show them was they were going to get essentially in today's value a 53% IRR on their investment. And this deal ended up getting done shortly after that, once they were able to sort of grasp and get comfortable with what the model was and the economics were to them as a shareholder, potential shareholder coming into this business, in a business that's been pretty steady. 3-year average EBITDA, that's pretty good. So there weren't a lot of ebbs and flows in the business. It was well managed. There was property management business as well. One scenario was this, where they're coming in straight as an owner and working through that. We had a second scenario, and this was similar to what David was talking about earlier as well. And we call this sort of the waterfall partnership structure, where you have principals that are non-producing that may just, be sort of managing, and you have others that are contributing to the business through their production and generating a fair amount of profits to the business. Well, how do you equalize that? A shareholder might come in and say, well, I make $1 million a year. I'm contributing $300,000-$400,000 to the profits, and I'm only a 20% shareholder. And you guys own 80%, and you're going to get the lion's share of that. So help me understand how we sort of balance the scales. So the way to balance the scales is sort of coming up with different categories or criteria of distributions to the owners. And what we did was we sort of tiered this, we call them tiered distributions. And the way you can do tiered distributions is basically structuring this where you have sort of each owner and breaking it down by their contribution to the company based on their personal production. So you can see here in the first box is we sort of said, okay, you know, there's a minimum profit you got to hit by covering your cost. How much did you contribute to the business? What was the net profit, and did you qualify? And if you qualify, then 20% of the profits will be set aside, and then they'll be shared based on your contribution. So you can see here, the second shareholder owns 36% of the company, but did very little in contributing to profit. And in the first tier, they only got 0.65% of the profits in the first tier because the other two contributed more to the bottom line. You can see the 20% shareholder got the lion's share of the first tier profits because they were sort of broken out by production. So, and then we take that first tier, and then the second tier is where you distribute based on equity. So you can start to see that once you formalize this, and the exercise here is to break it down so you come up with a formula that allows for all parties to feel like it's fair. So what we ended up doing here was showing sort of this client that, hey, you've got a seasoned producer, been with you for 15 years, now a chance for them to come into ownership. Their first question is, well, how do I do this? Like, how is this, you know, how am I getting 20%, but I'm accounting for all this production? So we were able to walk them down this path and then be able to show them in this box here that even though you only own 20% of the equity, when you look at the two-tier production distributions, you're actually ending up pretty well at almost a third of the business. And so this actually was able to get that individual to look at this through a different set of lenses and eventually understand the value that allowed them to benefit from over time. And then also sort of use that as a means to attract and transfer business to future shareholders as well. So those were the two case studies. I've been 45 minutes of me talking. Now I'm going to sort of open this up to questions. And I know there's a lot of information here that I just put out to the audience, and hopefully if you do have any questions, there were some questions put into the chat group, and if there were, I can address them now and discuss them and answer them to the best I can. No questions? All right. Did that go to
Hey, Obie.
Yeah.
It's Dave Pryor. You know what? When you assisted us, I think that one of the things that is important for some of these other guys to hear is that I owned 62.5% of the shares, having bought the founder out only a couple of years before. And I had Frank and Matt Stringfellow and a couple of other shareholders that were producers, but not necessarily interested in management. And when we consulted with you, and the amount of shares we sold to each person varied based upon my perception of them taking responsibility over time. And I think that was one interesting point. And you know, that the chart that Obie just put up with the different tranches of sharing of profits, ours was much more complicated because we had an existing profit sharing plan that the new shareholders would be brought into and participate in, and the existing shareholders and employees had participated in previously. And so we had a much more complicated structure than this, but the net result was that whether you were a shareholder or not, as an inducement to get people to come to work for you, if you made a lot of money, you got paid more than your commission split. And I think that needs to be said as well, because it has helped us. And we've finally had some non-shareholders now taking part of the profit pool because they went in excess of a certain level of earnings. And I'll also say, having been through this, that it helps to have good people you sell your shares to, but it's, people want to take responsibility. Frank and Matt are doing a much better job at certain things than I could have ever done. I'm happier, they're happier. And to think you're going to hold on and be cute with people in the end is probably the big message. You got to do this. Do it earlier rather than later. That's my message. And Frankie and I wanted to do this. We just couldn't figure it out until Obie came in and sort of translated for us. And in the end, I discounted the value below what Obie suggested, because you really make so much more money when you bring people into the organization. And the enterprise just thrives.
I think I'll add to David, one of the things that we learned in the entire process, and one of the big things we wanted to account for, was the fact that we did not want to end up with, and David is certainly not this person, and it was the reason he wanted to do it, the owner who owns 50% of the company and is no longer contributing, but is receiving and demanding 50% of the profits going forward. Mm-hmm. It's especially in a market like Los Angeles, it's a quick way to lose brokers, So we want to try and incentivize to continue so that, we could all keep doing this going forward and keep the company together.
And there's a 25-year age difference between me and Frank, which is very fortunate for Frank and very fortunate for me. And it creates a long runway for he and Matt Stringfellow and some of the younger shareholders. That you want to have that long runway for them so they see a long-term value.
Yeah, that's thank you for that, David and Frank. And I think one of the things you mentioned, which is really important, is the fact that, if as a producing broker, being an owner does give you the ability to make more than your standard split. I mean, we've been able to show that in depending on the scenario, but that income adds up. But then it's not just the income you have, it's also there's value in the units and the shares that you own too, long term. And if you have the right people and the right elements in place, that asset continues to grow. But it's only as good as those individuals and the ability to sort of have these pieces in place, which I think, to credit for Frank and David to see that early on and say, we got to figure this out, because long term, it's what's best for the business. Owning 50% of a company that makes $100 versus owning 10% of a company that makes $100,000. You got to sort of look at it through that lens. It's not the percentage you own; it's sort of it's the value of the business and the cash flows and the collective people that contribute to it. That can be a long-term, great source of income and value beyond where you're at today.
Yeah, and I think that the other part of that is we have a sort of a social cultural structure at our company. It's a lifestyle business, I think to imagine selling to an institutional brokerage company would have been the death knell, and everybody would have left and gone to an independent company. I like the independence. We're all in CORFAC because we like the independence, but help the younger people at your company continue that independence by doing something like this.
How do you establish the multiple value? I mean, what's a typical multiple for a small real estate firm these days?
Yeah, good question. So it really depends. There's a lot of variables now, more than ever. Market, asset class are playing playing a larger role than they have in the past. But traditionally, brokerage companies, and I'll tell you this, more of a sort of a historical average, have ranged anywhere from the low end 3 times EBITDA to the high end of 5x EBITDA, right? And it all depends on size, scale, market, concentration risk, which is how much of your revenue is concentrated to a few number of people. All of those things come into play, but that's typically the range to look at.
So if you sell your business to a bigger entity, then obviously you have to have some kind of I guess, work employment agreement with your producers. And so they're going to want a piece of that deal anyway. So by virtue of having producers in your firm, they may not own the piece of the firm, but to get that value, you're going to have to pay them anyway. Right?
Yeah.
I mean, is that pretty consistent
It's-
with
yeah.
what you're saying?
Yeah, I think, that's sort of the value of what we're talking about here, is that when you're looking at your business, whatever your long-term goals are as a business, you've got to think about how to maintain and retain that value long-term, because if it's just you as an owner bringing the value, then it's really, the business is only worth what you're worth, which isn't going to be much at the end of the day, because if something happens, then that's it. But if you have individuals outside of yourself that are creating that value, then it's in your best interest to make sure you're figuring out ways to keep them motivated and attracted to your business and retain them. And the best way to do that is sort of a vehicle like this, or other opportunities as well. But it all comes down to where you want to be in 5 or 10 years, and then you plan accordingly and get it done sooner than later. And then that's sort of always been the recommendation from us, is that that type of planning at the end of the day will only reap benefits based on where you're at 5 to 10 years from now.
I can tell you from experience that before the existing shareholders bought out Stuart Claiborne, he had talked to large national companies, and more than 50% of the value they were willing to pay Claiborne was actually going to go to retention bonuses for the producers, and he didn't understand that. It's like, well, wait a minute, it's my company. Well, no, you're not the company. You're just own more shares. So it'd be interesting if somebody went out today and had that assessment done, that you think, well, I'm going to get 2 million or 5 million for my company. Well, you're going to get less than half of that, because they don't want you. They want the guys making the money.
Yep. Any other questions?
It's not a question, more a statement really, is that the changing attitudes to the youthful brokers and real estate people. Now I just started my 35th year at Fairbrother, but the young kids coming through, do we all really believe that actually that what they aspire to is to be a business owner, or do they just want the healthy profit share bonus related type arrangements that come with broking these days? I think it's a very certainly from a UK point of view, it's a very interesting topic for us, because I think the elders through many generations have basically taken most of the money and not passed it down through discretionary bonuses. We have less of a rigid system than the States. Mm-hmm. But actually, just culturally, whether people want the responsibility of owning and running a business and the overheads, or whether they just want to basically come in and do work and basically take their appropriate commission and shared commissions and maybe a share of the profits without actually having any of the ownership and responsibilities. I wondered if you have a view on that.
Alistair, this is David. My longest partner in the business is Todd Togner, and Todd wants nothing to do with running the company. All he wants to do is transact, but he's a shareholder. I mean, I think at least in my experience, people truly, quote unquote, take responsibility, and who wants to be involved in the running of the company and not. And you get to know people over a period of, I don't think I'd sell shares to somebody before I had them at the company for 10 years. I think that's about when we sold shares to Frankie, because they weren't ready for it. Someone coming in from the outside is a different story, but I think I clearly recognized and people's behaviors made it clear who wanted to be involved or not.
Yeah, I think that's a great point, David. Alistair, I think it's really a function of understanding that, the mindset of this next generation is you're going to have different variances, right? You're going to have those that want to come in, hustle, work, and, be happy with just making their income and looking for a profit share. that may or may not be the model that works for you, but you're also going to have the opportunity to decide who the other sort of entrepreneurs are that are going to take ownership, and you want to offer them that, and they may be interested in getting that, or, you know, I think that's just a process, right? It takes some time and some effort on both parties, and more importantly, from your standpoint, to be comfortable in putting someone at that position as well.
Yeah, I think we have to think about our model very carefully in terms of remuneration levels. You know, we just lost a couple of people to the big, what I would call the big global corporates. Their base salaries were significantly higher than ours, but also their very clear remuneration structures. You earn, you know, for the company £500,000, you're going to earn X yourself. It was all very clear, almost on an individualistic basis. And I know that Savills have a very clear remuneration structure. With a company like a CORFAC company, I think certainly with the way in which the UK looks at its remuneration structures, as a partnership, we have to buy profit rather than turnover. When we actually get to the end of the year and we have a profit to be distributed amongst the partners, the bonuses come out of a bonus pool first, and then the partners get what's left. So if you have a good performer, you basically end up with less in your pot for your partnership than you do with your for your bonus pot for your employees. And I would only say, David, from my experience, and you know, I've come across some people who are very money orientated, and that's all they're interested in, is actually they don't want to run the company, they don't want to get involved in the nuts and bolts, they don't want to take any risks in terms of lease liabilities and banking liabilities and anything else. They just want to come in, do their deals, and that's all. And I just wondered whether that is a trait that we're seeing with a younger generation, whether the old model is still going to work in terms of succession planning. And Obie, by the way, my firm is 222 years old this year.
Wow.
So we've had quite a bit of succession planning, and I was not a founder member. But
Thank God.
Yeah. You've aged well.
But it's an interesting conundrum. I think succession is one of my biggest issues.
You know what, Alistair, you all but said, you know, the big earners get part of a bonus pool and not being shareholders, which is, with a few more twists and turns, the same compensation we have. So maybe, you know, I'm sorry to hear you've lost people, but are you enunciating that to the point of people realizing that in the end, it may not be that much different from what the nationals are providing to your people?
Yeah, I think that there's just a degree of short-termism amongst some of the younger fee earners across broking firms in London. They're happy, you know, they almost look at me and laugh on the basis that I'm clocking up my 35th year, is that there is a lot of bed hopping between broking firms in London at the moment, because people are assembling teams, and some of the remuneration packages, signing on packages are quite significant, and there's serious clarity. Doesn't matter how the firm performs, but if you as an individual perform, that is what you're going to get. So I think it's just something we've got to work through. There is a type of person that will come to us, there's no doubt about it, rather than go to JLL or CBRE or whoever, Cushman's. But I think that I hope it's not a dying breed. That's what I'm trying to say. Is I hope it's not indicative of the youthful generation. Basically, you know, if you want a friend, go buy a dog because I'm just here to make money. End of.
I mean, I believe it's alive and well, and I think if you get the right people, you'll have it.
Obie and David, I have a question for you.
Sure.
This is Michael Staskowitz. Good to see you guys.
Hey, Michael.
With the example of the waterfall structure you had on the board, using it as a recruiting mechanism, you know, let's say if you know, ownership allocates 20% for a recruiting carrot per se, knowing, like in David's example, there's a period of time that you want to vet that initial person before you get into the shareholder discussion. How do you Obie, what's some of your experience of addressing that obstacle? You want to sit and offer the opportunity for new producers to come in, but at the same time, you know that it's not going to be an immediate situation. Can you talk to some of your experience in that?
Yeah, so we've worked through sort of several scenarios, and unlike I think what Alistair was saying as well, is in certain cases, and you've sort of, the best way to frame this is think of the type of people you're bringing in and what their value is to the business. And one of the things that we've done is sort of these profit sharing pools, right? Where the ownership could decide that in the best interest of the business, we're going to allocate 20%, and it's going to be, sort of a profit sharing pool. And that pool will get divvied up based on qualifications of the producers coming in, right? So they may have to hit certain targets, and based on those targets, their contribution to the company defines how much of that pool they share in. And that could be a great way to sort of retain people with the thought process that it's almost like a law firm model where you come in as a junior partner and you become a senior partner at some point, where in maybe the junior partner is really a profit sharing interest. And once they perform and achieve goals, and they have the ability to essentially become a true partner and participate in that 80%. So I would say, Michael, to your question, I think that's a great way to sort of get into that first step of the process, and maybe build those sort of rapport with those people to see what motivates them, and are they truly ownership material or not. And then, have that be sort of that measure long term to offer up ownership or not. But I think we've seen it work. It definitely has worked. It's just a matter of, the ownership really feeling confident behind it, and seeing it as a retention and recruiting tool itself.
Great, thanks.
Yep.
David, you're on mute.
And you're on mute.
Of the 8, I think we have 8 shareholders. Of the 8, all but 1 were homegrown, meaning started at the company and grew up in the culture. And I think that's critical as well. Is hiring. Hiring is a whole nother subject, but I think it, in the longer term, plays into this. That's all.
Any other questions for Obie before we sign off? Obie, thank you very much as usual. Fantastic. This session was recorded, so we will be distributing this to CORFAC Nation, and it'll be available to you.
Thanks, Obie.
Thank you, everyone. I appreciate it.
Obie, thank you.
Forward to hearing from everybody soon. Take care.
Thank you as always. Good night, guys.